Welcome to this explainer. We've come a really long way from the world's first stock exchanges back in 17th century Amsterdam. Back then, it was just merchants trading paper shares of the Dutch East India Company in these noisy, bustling courtyards. While today, we're exploring an absolutely unprecedented moment in financial history. We're looking at how artificial intelligence is completely rewiring those global markets right now in 2026. We are currently balancing massive, historic technological growth against some very real and very potent macroeconomic risks. It's a high-stakes tug-of-war, and by the end of this, you're going to understand exactly who and what is pulling the strings.
Okay, here is our quick agenda for today. We're going to cover the AI market supercycle, NASDAQ and tech dominance, how machines predict markets, the 2026 economic outlook, energy shocks and credit risks, and finally, the future of trading.
Section 1, the AI market supercycle. Let's dive right in and look at the absolute tidal wave of capital that's currently flooding the global market.
We hear a lot about AI, right? But the actual dollars and cents behind building it are staggering. There is a frantic arms race right now to build the future. A year ago, Morgan Stanley originally projected around $450 billion for combined AI capital expenditure among the biggest hyperscalers, but that estimate has totally exploded. It's practically doubled to roughly $800 billion for 2026, and get this, it's projected to surge past $1 trillion, $1.16 trillion to be exact, for 2027. We are talking about massive investments in physical infrastructure here: data centers, power grids, advanced chips, and networks. This level of spending is fundamentally shaping equities, credit, and even commodities for years to come.
Moving on to Section 2, NASDAQ and tech dominance. Let's see exactly how this historic trillion-dollar spending spree is physically manifesting on the world's exchanges.
Just take a second to wrap your head around this number: $35 trillion. That is the NASDAQ's market cap as of March 2026. This immense valuation is being driven almost entirely by mega-cap technology, software, semiconductors, and AI growth companies. But here is why this matters to you: concentration risk. When just a handful of very large companies dominate the market's overall performance, it's fantastic when market leadership is strong, sure. But it also means that if valuations reset, the drawdowns can be incredibly sharp.
Which brings us perfectly to this warning from Morgan Stanley's chief cross-asset strategist, Serena Tang. She points out that investors need to remain constructive, not complacent. Yes, the macro and micro fundamentals right now totally support risk assets, and AI is generating real earnings power. But the environment is shifting. You've got to be constructive about the growth we're seeing, but you absolutely cannot fall asleep at the wheel when it comes to the risks bubbling just beneath the surface.
Section 3, how machines predict markets. So how are investors actually trading in this hypercharged environment? Well, increasingly, they aren't. The machines are.
We've completely evolved past the days of human beings sitting at desks, manually reading financial statements and tracking fixed indicators like price-to-earnings ratios. Today's modern AI prediction models operate in an entirely different stratosphere. They use natural language processing to read millions of data points instantly. They gauge global market sentiment from social media and news feeds, and they apply dynamic weighting that adjusts to macroeconomic shifts in real time. It's a fundamental transformation of how we actually value assets.
The really crucial point is understanding how a modern AI trading bot actually works in practice. First, it constantly sweeps up unstructured data, literally everything from a CEO's tweet to a sudden geopolitical news flash. Second, it uses that natural language processing to perform sentiment analysis. It's essentially reading the mood of the market. Third, instead of rigidly relying on static historical metrics, it uses dynamic weighting, basically adjusting the importance of various economic indicators right on the fly. And finally, it executes the trade. All of this happens by exploiting micro-price fluctuations in mere milliseconds, long before a human brain could even process the information to click a mouse.
Section 4, the 2026 economic outlook. With these supercomputers driving market activity and predicting trends, let's look at where the physical economy is actually headed.
Right now, the US is effectively carrying global momentum on its back. Despite uncertainties, US GDP growth is projected at a solid 2.25% this year, and it's expected to rise to 2.5% in 2027. So what's powering this engine? Well, it's that massive AI capital spending we talked about earlier, combined with very resilient consumer spending, which is particularly buoyed by the top end of the wealth distribution.
Because of this strong underlying momentum and an incredibly robust 23% expected earnings growth for 2026, Morgan Stanley has confidently set their S&P 500 target for mid-2027 at a massive 8,300. The corporate earnings surprises we've seen recently have been the strongest in years, largely because AI isn't just hype anymore, it's actually helping companies optimize their operations and materially boost their bottom lines.
All right, Section 5, energy shocks and credit risks. It can't all be perfect, right? What could possibly derail this incredibly optimistic, tech-driven economic outlook?
It's the multi-trillion-dollar question every major analyst is asking right now. What external forces could bring this $35 trillion AI juggernaut grinding to a halt? The machines might be perfectly logical, but the physical world they operate within is highly unpredictable.
The single largest variable hovering over this entire outlook is the risk of a Middle East supply shock. Under the base case, if crude normalizes around $90 a barrel, the global economy can likely absorb the shock. But if the situation persists and shipping normalizations fail, we enter a shock scenario. Oil could surge through $150 a barrel. And at that point, we shift from a mere price shock to a physical volume shock. We're talking supply chain disruptions and petrochemical shortages that could literally stop global manufacturing in its tracks.
Now, the pain of an energy shock won't be felt equally across the globe. China is the least exposed because they've actually built up massive oil stockpiles. The US has medium exposure. As a net exporter, they have a buffer, but everyday consumers will still absolutely feel the pinch at the gas pump, which could threaten that vital consumer spending. Europe, however, is the most exposed. Because they're a net importer of energy, a shock there means an incredibly fast pass-through to household bills and business costs, and that directly feeds inflation.
Beyond oil, there's a really fascinating risk growing inside the AI boom itself. Building out these massive AI data centers requires staggering amounts of capital. Companies aren't just funding this with cash on hand, they are borrowing heavily. This is creating a total flood of new corporate bonds hitting the market. Even for high-quality US companies, when investors have so many new bonds to choose from, they're going to demand better terms and higher yields. So paradoxically, the very AI boom that's supporting stock earnings could put intense pressure on corporate credit markets.
Section 6, the future of trading. As we look past 2026, how will the very mechanics of the market evolve to handle these immense, high-speed pressures? Well, the AI models of today are really just the beginning. Research shows we're rapidly moving toward quantum computing to process incredibly complex market data and technical analysis near instantly. Simultaneously, the integration of blockchain technology and decentralized finance, or DeFi, is utilizing smart contracts to completely eliminate middlemen in financial transactions. Just imagine AI bots executing trades instantly on an immutable blockchain ledger, minimizing fraud and maximizing efficiency. But there's a catch. Giving machines total control creates a terrifying black box problem. If an algorithm causes a sudden flash crash, we need to know exactly why. That's why developers are aggressively focusing on explainable AI, or XAI. These are methods and techniques designed to ensure that the complex trading signals and predictions made by these highly advanced deep learning networks can actually be easily understood, verified, and audited by humans. We have to ensure that as the machines get smarter, we don't lose our ability to understand their logic.
Yet, for all this dizzying technological advancement, it is totally vital to remember what we're actually doing here. No matter how advanced the dynamic AI algorithms become, no matter how instantly quantum computers process data, or how transparent blockchain ledgers are, the fundamental heartbeat of the market remains exactly the same today as it was centuries ago in Amsterdam. Businesses need capital to grow their ideas, and people want to invest to build wealth. The tools are revolutionary, but the human drive behind them is constant. Which leaves us with one critical thought to take away from this explainer today. As our markets become almost entirely dependent on machines executing complex trades in fractions of a millisecond based on data we can barely even track, is our financial system actually prepared for the unpredictable, messy chaos of human behavior? Things like a sudden geopolitical conflict or an energy shock. We've built the most perfect logical market machine in history, but we're about to find out how it handles a highly illogical world. Thanks so much for learning with me today, and I'll catch you in the next explainer.